Welcome back to the What's Your One More podcast. I'm your host, Quinton Harris, and we're diving into episode 156. In this episode, what we're going to do in back-to-back episodes is break down an outlook for 2024 and into 2025. And the reason we're going to do this is we do a lot of presentations and we get asked all the time, hey, can I get a copy of the slide deck? Can I find a way? Are you recording this? And we've been doing this for about 8 years and we've never really recorded it. And with the podcast and the platform, it was like, why shouldn't we do this? So we are. So in this episode, what you're going to get is an outlook in rates through 2025. You're going to get a forecast on housing through 2025. Because we're in Jacksonville, we do a little bit of a Jacksonville deep dive, but we're not going to harp on it too much, but we'll give you enough to make sure you understand what we think about this market. Now, we're going to break into 2 episodes. So in this particular episode, you're going to get the market update, kind of a little bit of the Fed and the Fed policy and where their mindset is and what they've been doing for the last 22 months. And the reason why that's important as we move into this new rate cycle and this new era. And then we're going to talk about future projections in the back half of the second episode. So without any further ado, let's jump right into it here. So our focus on today is what we want to talk about is where are we now in the state of real estate? And then what's the status on rates? And then what does the future status of rates look like? And why housing is not a bubble asset. Now, the reason I put that last one in there is this. A lot of social media and a lot of YouTubers want you to believe that housing is on the verge of crashing and that there's this bubble, there's this asset bubble that's being created. And as we've talked about time and time again, the supply-demand curve inside of real estate is over demand and under supply. The demand is so high in comparison to the amount of supply we have around the country. That is the basic formula as to why this is not a bubble. The bigger question is how much higher housing can go. And that's all based on affordability, which we're going to spend the first episode here talking about quite a bit. But let me explain our approach when we do this. And when we're talking to an audience, we always say, listen, I don't go out and try to create a narrative and say, oh man, housing's so good. I'm going to go find all the facts that support that. That's not what we do. What we do is we collect market data and then we give our opinion on what we've collected. We research macro trends on the national and local economy. We create these visuals. We create these graphs that we're going to show you today. And then we provide projections based on that. We take a very holistic approach of all this information and we digest it and we share what we see in trends. So I just want to make sure that's clear. We're not going out trying to find all the positive and not look for any negative. If negative is there, we're going to show it. And in some of the cases, we do talk about that here today. But I always like to lead with our objective and how we do this. So let's take a look at where we are currently. And I think in order to do that, you have to look backwards a little bit in 23 and talk about some things that have happened. You're going to hear me talk a lot about Jacksonville MSA. And what I mean by that is if you're part of our Jacksonville audience, if you're a real estate agent, if you're a lender, what I'm referring to is Duval, St. John's, Clay, Nassau, and Baker. Those are the 5 counties that make up the MSA. Recently became 1.71 million in 2023 population, the 4th largest city in Florida and the 39th largest in the United States. So when you hear me talk about Jacksonville MSA, that's what I'm referring to. And then obviously we have other areas that we'll talk about as well, but that's going to be our emphasis here for our audience today. So let's start with 3 basic slides. And these 3 basic concepts that I'm going to talk about, this is what I want to be in the back of your mind, or maybe even the forefront of your mind while we're talking about these projections and why. So when you look at an industry cycle, this could be really a lot of different industries. But let's apply it to real estate. You start a cycle at this beginning of normal, and normal is balanced, right? Everything is calm in the market. And in time, and these timelines can be different, but I'm going to use 2018 as normal. And then expansion, you go from normal to expanding. And this is where the industry grows in business and profit and companies expand operations. This started to become a thing in about Q3 of 2020. As we started to digest what COVID was looking like and what was going on, real estate started expanding because the demand in housing picked up and people were at home more. And we all understand what was going on during that time, thus leading to the expansion. I would say probably Q2 of 2021, we entered that 3rd phase of the cycle, which is chaos. And so if you were in the business, you understand, if you were buying a house, you understand the chaos that took place during that time. And as you get into chaos, growth attracts more competition. And during that time, in 2020, I might have had in just our local market, we may have had 3, 4 competitors in a 5-mile radius. By the time chaos hit, we had about 21 competitors in that same range, just in mortgage lending, and real estate saw this as well. You had new real estate firms coming to the table. You had people creating their own brokerages. Chaos was starting to happen. Well, that leads into the next phase, the final phase, which is consolidation. And I would say consolidation started probably Q3, late Q4 2022, you could argue. But consolidation is when companies get acquired or essentially go out of business and the strong survive and gain market share. And that's what we started to see in late 22, and it worked its way through 23. And so the good news about consolidation, and I like to say this, is that we're so close to getting back to normal. We're that much closer. It's the fourth and final phase as we go back to normal. Now, this may appear to be a 6-7 year cycle. Sometimes it's 6-7 months, depending what industry you're in. But you could look at a lot of different industries, and these industry life cycles are very common. I just wanted to explain the one for real estate. So the good news is we're getting that much closer to normal out of consolidation. The other thing I want to talk about here was the Fed's influence on the economy. Now, we have done, this is our 156th podcast, so we've done a lot, and we've talked a lot about the Federal Reserve. But I put this in a simplistic manner when you're thinking about the Federal Reserve and the credit cycle. So credit cycle for the Federal Reserve, they have two different types of policies, loosening and tightening. Currently, we're in the tightening phase. But what I want to really spend some time is talking about where we were in the early 2009, 10, 11, 12 period. That was a loosening cycle where the Federal Reserve had lowered rates and was starting to purchase a tremendous amount of assets, be it mortgage-backed securities, treasuries, the list goes on and on. But what happens is when you go into a loosening cycle, this expansion process starts in the economy. And that's the whole point, is you want the economy to thrive when you start loosening the monetary system, meaning the Fed funds rate becomes basically down to zero at this case in this time frame, and money was cheap. So expansion was easy. You could borrow cheap money as a business. You could create new facilities. You could create new jobs because you were creating new products and you were building on your current catalog of products that you had. Same thing for services. And if you stay loosened for too long and too much expansion happens, there's a lot of money in the credit cycle, and then inflation starts to happen. And that's exactly what happened probably about 24 months ago. We started seeing that come about. And so the Federal Reserve has no choice but to tighten that faucet, right? So if they're turning the water off of the spigot, that's tightening the credit cycle, water being the credit during this analogy. But they're tightening the cycle. So the opposite of expansion is contraction. And so you go into a restrictive policy. And so contraction happens in a form of business, such as the money is too expensive. Businesses stop borrowing for new facilities. They stop borrowing to create new jobs. They stop borrowing because they're not making as much product. And that in turn becomes a restrictive territory. And we've been living in that for about the last 22 months. Now we've started to see some stability in the form of the Fed's policies, but this is a very important credit cycle because the other side of restrictive is back to loosening. See, because you come out of that tightening cycle, you get back into that loosening cycle. That means we're getting closer to that. So in my previous slide, we talked about getting back to normal on the life cycle of the industry. And now with the Federal Reserve, we're getting closer to the loosening. And that's really important because those both benefit the real estate market and benefit mortgage lenders and real estate agents and ultimately customers. And I share that because these two slides to me scream why housing is not in a bubble. When you get in these echo chambers of YouTube or social media and you look up something about housing and is it overpriced, you're going to find more of that backfill into your channels. And so sometimes it's difficult to not understand why housing is not in a bubble because you're surrounded by that. But I'm trying to give you facts over fear. And I credit one of my real estate partners who told me that. And I thought that was just a fantastic statement. Facts over fear. And I think that's really important because if you're going to be purchasing a home and you're going to be making a major decision, arm yourself with the facts. Don't necessarily let fear take over the facts. And that's real important. So one of the things I want to point out in this slide is you'll see a lot of different housing markets here. And this is courtesy of our friends at Zonda. For those of you who don't know what Zonda is a data point of collections for a lot of new builders and transactions across the United States. They're a wonderful team and we enjoy working with them over there. But this is a slide that they put together. Essentially ranking all the different markets on their transactions, right? And how many are being done and what does it look like? You'll see there's a heat map, and the really dark, almost master's green, if you may, that is when you are having significantly overperforming markets. Yellow would be average, and then bright red would be significantly underperforming. And I think if you're in the business, none of these are really a shocker to you. But as I take a look here in Jacksonville specifically again, for us, we're at average, right? And if you look at our neighbors, they're overperforming, which bodes the question, like, how could that be happening in Jacksonville when you look at some of the other things I'm about to show you? And I think for us, there's a tale of two buyers taking place in our market right now. We have this local buyer, and you can define a local. I polled the audience at the last one we read, and I was like, what defines a local? How long do you have to live in Jacksonville to be considered local? And people were yelling out 10 years, and I thought that was maybe a little longer than what I was hoping to hear. But however you define a local to your market, we're a very transient market. That's why I think that number came out there. But locals are still trying to make sense of the market, meaning that, hey, I can't believe that home that I looked at 5 years ago is now priced at this. And maybe that's in your market as well. You've got locals going, there's no way I'd pay that for this home. Are you kidding me? What are they thinking? You know, you hear all the commentary. But then there's this newcomer, if you may, this new person moving into Jacksonville. And we're going to talk about where that net migration is coming from. They're digesting this market a lot quicker. They're going, man, this is a great deal compared to where I just moved from. Bought, sold, maybe even overpaid for the price point just to win the deal. And that is adding what I would say price pressure to our market. We're starting to see homes increase higher, quicker, faster than probably anticipated. So sometimes when you have that type of tale of two buyers, it creates a little bit of a pain in the market. That could explain why we're seeing average performance. For example, Orlando looks to be overperforming, Tampa's overperforming, Miami's overperforming, Naples overperforming, moving to the San Antonio market, overperforming, Charleston's overperforming, Nashville is overperforming. Philadelphia is overperforming, Minneapolis, Chicago, Las Vegas, Los Angeles, San Bernardino, Phoenix. So just to give you some examples of markets that are overperforming, some that are underperforming, Salt Lake City, San Francisco, San Jose, San Diego, again, Cape Coral down in Florida. I think some of those do Colorado Springs. I don't think some of these come as a shock to people in the industry here. And if you're in those markets and you disagree, we'd love to hear your comments and feedback as to why. But what's great about Zonda is they have feet on the ground. Like they have people actually in these markets digesting this. They have economists out there in this area tackling this stuff. So it's great to have them as a partner to get this information here. Let's take a look at some rate projections and rate forecasts. This seems to be the million-dollar question I get all the time. No matter if I'm doing speaking engagements, if I'm walking into a real estate office, or even at my day job over at the bank, I get this question all the time. I think in order to start with rate projections, one of the things I have to look at is where are we now? And the reason I say that is because we talk about this lock-in effect. And I think the lock-in effect impacts inventory, current inventory, as well as current buyers. And I wanted to start with this graph. Now, if you've been tuned into our channel, you've probably seen this graph before because we did it about 4 months ago. We just updated it, but nothing's really changed on it, meaning that if you look at this graph, about 90% of all mortgages in the United States are 5% or below. So you'll see on this graph how much of those percentages are allocated towards interest rates. Like, for example, 32% of all loans in the United States have a 3% or less. And then 27% are between a 3.5%, 17% are between a 3.5 and 4, and then the numbers get smaller as the graph grows. But I think what we're seeing here is the bulk of these are 4% or less. So it bodes the question, like, what is the interest rate going to take to unlock these deals? Well, there's a couple of things that we have to think about. There are budgets that are locked in right now. There's homeowners that go, I am comfortable with this payment, all in, PI, TI, this is my comfort zone because it allows me to afford this car. It allows me to pay this electric bill. It allows me to get this kind of food at the grocery store. Like, especially in a world right now where there are significant struggles for a lot of people, this number is important to them. I don't know what the interest rate has to get to, but as I continue to poll these audiences, what I'm hearing is that if the rates were to get somewhere in the 5s, you're going to unlock quite a few of these buyers and these homes because the budget then makes sense for them to make that move. And so what we're looking at in this graph, this is pretty much all of our move-up buyers, meaning they own a home now and they would want to buy something probably bigger to move up in their home because either their lifestyle has changed or their household has changed, right? So this is what we would call a move-up buyer. This buyer is currently locked in, which is why we've seen them leave the local market in pretty much every market, not just local, all markets. And so let's talk about Jacksonville's lock-in effect. We currently have 696,000 households, but 620,000 of them have a 5% or less mortgage in this particular case. And the average homeowner has about 100,000 in equity. And when I take a look at that, think about what happens when these rates come down. And they will come down. They absolutely will come down. Just the question becomes when. But when they do, imagine what that looks like on the other side of this rate fury that's going to happen. Are we going to see 2021? Are we going to go back to chaos again? I don't think we'll get back to chaos, but I definitely think we're going to have a significant amount of transactions in a market. We might have less agents. We may have less lenders, so it may feel more chaotic, but I don't think we'll get back to the same transaction counts we were doing. But if and when those rates get back in a comfortable area, you're going to see a new buyer come to the market that's been gone for roughly about 18 months. So when I think about real estate agents and I think about mortgage lenders, we're in this world right now where we have to reset our expectations. And Alex Hormozy says this quote, he goes, "We want a guarantee from a world that won't give us one." And for me, that resonates a lot in this industry over the last 18 months, because as a mortgage lender or a real estate agent, I want the ability to come in and say, if I do these 10 things, it will yield this one result. I want that guarantee, but the world that we live in right now isn't going to give that to us. And there's always these metrics that you have the amount of METs. If you meet X amount of people, it'll yield a result. Or if you're a lender and you call X amount of agents, it'll yield a result. It's just not there right now. And so we're having to reset our expectations on how we do things. And in the same manner, we have to reset our expectations on rates, because in the past, you would always say, oh, what goes up must come down. And if this inflationary index does X, it'll yield a Y result. And as we've all learned in 2023 and been very humbled by that, none of that made sense and none of it was correct. I don't think there was a single person that did a rate forecast that was even within 1.5% of what the rate was going to be. And it's one of the things where we're doing a rate forecast right now, and I always talk about, well, if you're going to do it, you should probably update it daily and throw it away each day, because 23 taught us that they change all the time. So I'm putting myself out there a little bit with this, but we're going to continue to update it, and we'll revisit it every single month just to stay in line a little bit more. But one of the things that we're very confident about rates particularly starting to edge down, I'm not saying drop, but edge down in 24 and beginning to look better in 25, is going to be the difference in the 10-year Treasury and the spread on the 30-year mortgage interest rate. Now, what you'll see on this graph that I have up here is you're going to see these blue bars that represent the 10-year Treasury, and where they were on the left-hand side represents where they were on their particular yield that day during that month. And then on the right-hand side represents the interest rate attached to that particular yield of the 10-year Treasury, and an orange trend line of the 30-year fixed rate to show you that. What we'll find is that we've talked about over really the last, I think, couple of maybe, I don't want to say years, but definitely over the last 18 months in our episodes, we've talked about Daniel Halverson's spread on the 30-year has gone up. I even did an episode where the MBA, the Mortgage Bankers Association, wrote a letter to Jerome Powell saying, hey, listen, because of the pressure that you guys are putting on the banking system, there's a high level of uncertainty due to some of the collapses of SVB and Signature, and the list goes on, that this new premium is being added into the mortgage interest rate to offset some of that risk and volatility. And so traditionally speaking, you've always been able to say, hey, if the 10-year Treasury is X, you could add 150 if you may, basis points, 150 basis points or 1.5 to that Treasury note, and that's going to give you a predictable 30-year fixed rate mortgage. For example, if you look on this graph here back in, I think it's July of 20, you'll see at July of 20 right here that we were at 1.5 on the Treasury, right? Excuse me, that was March of 20, we were 1.5 on the Treasury. If we look at the mortgage interest rates, 3%. That's 1.5 plus 1.5, 3%. That makes sense. That's how predictable that was. As that volatility entered the market going into 22, we started to see that spread go from 1.5 all the way up to 3.5. And that's a big problem because it was falsely inflating the 30-year fixed rate. That's why we jumped so high in a manner in such a short period of time to where people are going, why are we at 8% interest rates? Now, what we're starting to see is because the Federal Reserve has maintained their policy consistency over the last 8 months, some of that volatility is escaping the market, and we're starting to see that number get more in line to that 1.5, which is encouraging. That also bodes the question that you don't need a lot of movement from the Federal Reserve. Matter of fact, they don't even have to lower rates. What they have to do is stay consistent, and you're going to see 30-year fixed rate drop. And we're already starting to see that. And this graph is the proof in the pudding. If you go back to November of 23 on this graph, when the Treasury was at 4.6, we were at very close to an 8% rate, 7.75, 7.875. If you go as of recently into April of this year, we hit that same point, and yet we're 7.25. So you're already, in just comparing apples to apples in a 6-month period, the spread is starting to evaporate. And that's very important because as we start to see the 10-year Treasury drop just a little, and it's going to drop, you're going to see more favorable rates. And that's why we can confidently come on here and say the Federal Reserve really doesn't have to lower the Fed funds rate for the 30-year fixed rate mortgage to improve, because the spreads that were falsely put on there are starting to evaporate. Now, I know that might be a little analytical, a little high level, If you have more questions about that, please leave some comments on our channel here and we'll dive a little deeper in that and explain it to us further. But this is an encouraging sign for those in the industry right now, because I think that it's something we haven't seen and we've been tracking and waiting to see it. And that for us was encouraging. But I think the challenge for the Federal Reserve is a little bit of this next slide. And you don't have to be looking at it to understand, but if you're not, let me kind of describe it. What I've got is the trend line really since 2022, October of 22 for the 10-year Treasury. And then right above it, I have the money market funds trend line. Now, the reason that's important is that if you're an investor, you're constantly searching for yield, return on investments, right? Interest. We call that yield on the banking side. It doesn't matter if it's an investor like you or I, an institutional investor, other banks, but you're always searching for that return, that yield, if you may. And so when we look at money market funds, what's interesting about that starting in this October of 22 timeframe is that the money market funds started to go up significantly as the Federal Reserve started to increase and tighten that policy by raising short-term interest rates, because money market funds are short-term rates. They're also risk-free. That's the thing that's interesting here, is they're risk-free. And as the Federal Reserve raised the rates at such a high level, well, I think one of the quickest on history, the money market rates became very attractive to investors. Normal people, again, like you and I, and hedge funds and the traditional investor, gravitated our money towards those funds because they got to 5.25 or 5.3, in some cases 5.5, where you're literally in a short term, every 24 hours you can get out of these things and there's no penalty, but you're getting that kind of yield at 5.25 or higher. Well, if the Treasury, which is a 10-year, in this case, the 10-year note, that's locking your money up for 10 years. And so what we see in this graph is every time the 10-year Treasury got close, and adamantly close to the money market funds, you saw investors say, wait a minute, okay, now I can take some of these short term and I can put it into long term and I can buy those yields for 10 years. And I'm guaranteed based on the full faith of the federal government. So this is a win. Someone moved money from the money market back into these treasuries. And then what would happen is buyers would come to the market and the yield on the Treasury note would come down because it's offsetting the amount of purchases that are happening. So in this particular case, one of the things I want to show you is sometimes as the treasuries get higher, it's better because more buyers come to the market. Now, keep in mind, the largest buyer right now is gone from the market. That's the Federal Reserve. They have traditionally always been the largest buyer, so they're gone. And the second highest buyers are going to be essentially the people of the United States, right? The taxpayers and people of the United States that are investors buying in these. And then there's this thing called foreign participation. And the foreign participation is when other countries step in and buy that. And those are traditionally speaking in this order, Japan and China. And they're not in the market right now to do that. So we don't have a lot of buyers. So you're seeing this yield having to get higher than normal to attract more buyers. Now, yes, more buyers will come to the table. Eventually, the largest buyer will return. And then so will some of that foreign participation, or maybe it might be new foreign participation, but it will show up. But between now and then, as this yield gets higher and gets closer to the money market funds, you see more buyers come in and a retreat of the 10-year, thus impacting mortgage rates in a positive way. And I'll show you that here in this graph. So every time, and I put and highlight the areas, it got above or right at the money market line, the 10-year Treasury, buyers came, treasuries dropped, buyers came, treasuries dropped. And we're starting to see that get closer to that line as I'm making this podcast, which means the Treasury will drop as buyers come, and we're going to reap the reward of that in the mortgage market. And as I just discussed, with the evaporation of that spread, it won't take much to move the needle to get these rates in the sixes sometime soon. However, here's what I want to show you why this is important. The next slide goes all the way back to 2021. And what you'll see is during this 0% era of the Federal Reserve, there were no buyers of the money market funds. It was flat. It was 0% interest, right? No one wanted to put their money in there, so everyone was buying treasuries. And when everyone's buying these treasuries and there's such high demand, they're suppressing the yields, which means the yields aren't rising as quickly as they should because there's no level of attractiveness in an alternative investment to put it in as far as short term. And then, as you'll see, just like clockwork, the stair-step pattern that happens on this graph, starting in about really April, May of 22, when the Federal Reserve started raising short-term interest rates, boom, money market funds went up and started becoming a better investment in the form of short-term yields versus the spread on the treasuries. This screams, again, another instance as we're getting back to normal, as I talked about in the first part of this podcast, and how we're getting closer to a potential interest rate decline. And again, I want to stress to our audience, it doesn't take the Federal Reserve lowering short-term interest rates. It doesn't take the Federal Reserve come out and saying, okay, we're going to lower it a quarter for mortgage interest rates to improve. That's really important in this conversation here. And that's one of the reasons why I confidently think you're going to see some improvement. The last two slides as we wrap up this episode are, one's going to be our forecast, and the other one is this election year. I call it a pullback because we go all the way back to 2007, and there's a significant trend of what happens in any market, and this one's particular at Jacksonville. You'll see the transaction counts go down in almost like this sharp spike down, so almost a V shape, if you may. And it's a very quick one here. But what happens is, regardless of the interest rates during an election, sometime during the month of September and October and going into November, transaction counts go down, meaning that buyers pull out of the market. Levels of uncertainty. Maybe they're scared. Maybe they just want to see what happens, right? But I can tell you, I remember sitting in my chair in my office, and my loan officers were coming to me in 2016. So this would have been the Trump and Hillary election. We had customers pulling out of contracts in the month of October, late September, going, I'm just so up in arms. I don't know what's happening. I'm just cancel the contract. I just don't want to do anything until the election's over. And it wasn't just one or two. It was about 50%. And what was happening was they were essentially foregoing their earnest money. They didn't care. Sometimes it was $5,000. Sometimes it was $2,000. Sometimes it was $10,000. They didn't care. That much uncertainty to them wasn't enough to stomach that earnest money and move forward. The media had a lot to do with that. And I imagine we're going to see that again here in this November, in the fourth quarter. And so I show this trend line because, again, I attach the interest rates to the terms, and we go back to 2008 with Obama, 2012 with Obama, 16 with Trump, and 2020 with Biden. What you'll see is this actual buyer leaving the market, but coming back in a rampant manner within the next 3 months. And so you'll see this, and I encourage real estate agents and I encourage loan officers, don't panic if that happens, right? Because there's this massive return that comes back to the market that you'll see once that certainty sets in. And we've been doing the podcast for 2 years. We've never had an election year during the podcast. And as I was telling the group of people I was speaking to on Friday, I've done this presentation for you guys 4 years in a row, and we've never had an election year conversation. And this is the first time. And I've been doing this for 23 years. I've seen multiple elections, and the pattern is consistent no matter where you live. So don't be surprised if there's a pullback. You might have a rock star September, October, November. You might not. If you don't get in your head that the business is having an issue or that there's this issue happening in housing. The pullback's natural during the election year and very common. It's what happens after that is a big windfall for the industry. All right, as we wrap it up, here is my last slide, my last forecast for the interest rate portion of the conversation. We'll come back on the next episode to talk about projections for housing. But let's look at this forecast here. What I did is I went all the way back to Q1 of 21, all the way through Q4 of 25. I put Fannie Mae's projections on here, and I put the MBA's projections on here, and then I put one more projection on here. And what you'll find is that us lenders, us bankers, we're all in the same type of mentality of where we either want the rates to be or where we think they should be. And we're right in line with MBA on that, maybe a little bit more hopeful than them. But what you find with Fannie Mae is that Fannie Mae, their projection stays in the sixes and then goes up into the 6.5 range and comes back down. And what that's telling you is they are anticipating inflation to either be stubborn or to come back and rear its ugly head, and the Fed to have to take another policy potential pause, less loosening, maybe a little bit more tightening, but that's what you're seeing in their forecast versus the MBA. And over here at One More, we think that's going to stay with a 2 handle on it, and that we do believe that the Federal Reserve is going to stay either paused or start loosening up some of their policies. So that's our forecast and why you see us in that 5.7 range into Q1, Q2 of 2025, and in the 6% range in 2024, Q3, Q4 there in 2024. So guys, if you like what you're hearing on this podcast, if you would, please share it, 5-star review it on any podcast platform you listen to. Leave us some comments. We threw a lot of stuff out here on this. And if we're talking too fast or we blew over something and you want to get a further digestion on that, go to our YouTube channel at What's Your One More, leave some comments. I promise you when you guys do that, we read them and we do go back and tackle those things, whether it's, a direct message or right here in the episode. So thank you guys for tuning in. We'll be back with part 2 of this episode when we release the next one here at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life